Welcome everyone to our weekly live session. I thought we'd run a live session because we had quite a bit going on. Some things wanted to talk about quickly. I think is important. The date today is Saturday, October 15th, and we just came off some pretty eventful. Weeks, we are kind of continuing to sell off a little bit more aggressively over the past month or so, especially on the indices. We are past our June lows, so that's pretty significant. And we have a CPI print that just released this past Thursday, and it was higher than expected, around 8.3, I believe, if I'm not mistaken. And with that, the market sort of bounced quite a bit, pretty really strong actually. And following that, on the Friday after, which was yesterday, we had quite the sell-off. I think a lot of it was, short covering, sort of temporary by the news. Um, and we are kind of continuing lower to close off the week this past week, which is weekend October 14th. My thoughts on this is I think that CPI kind of came as a bit of a surprise, coming in higher. I expected at least a relatively stable or lower than expected, although it was a little bit higher. And with that, I think it insinuates that the Fed will continue raising rates. I think that would be a mistake to go too aggressive, especially so fast, as it would put too much pressure on the economy as a whole. We do see, in consumer spending numbers that also released this past 2 weeks, that consumers are reducing spending, and especially on luxury goods, which is significant. And then you see a little bit of a balance where some sort of modern day staples are not getting as aggressively reduced with spending. For example, things like monthly Spotify subscription. People are not reducing spending on. Although we are seeing data that people are reducing spending on more higher level grocery stores and switching to more cheaper alternatives, in regards to groceries, clothing, etc., and that sort of household spending. I think that goes to show that consumers, especially U.S. consumers, or consumers in the Western Front, are adapting and adapting their habits to adjust for what they believe is impending in front of them in the economic situation. And that's sort of a double feedback loop as well, as where consumers reduce spending, it goes to further feed the economic data that is provided to make decisions on rates, etc. So what I think is possible, in the next coming 2 months into the end of the year, November, December, we do have a FOMC meeting in early November. I think it's November 2nd to 3rd, which is the 2-day meeting. And then we have another one to end off the year on mid-December, I think December 15th or 16th. And in those, I think that the Fed might actually raise once more. And what that would do is get us to that sort of previous level of rates where you're at around 4 to 5%. Um, and then once that occurs, I think that they would be done from there. I think that'd be the best situation and the most economically efficient situation that the Fed would do. I even posted a article regarding the Bank of Canada comments on rates just last night because I think it's significant because Bank of Canada and typically follows U.S. Fed quite closely, and I think the Canadian and U.S. Economies as a whole are quite interrelated, and the Fed sort of shadows the BOC sort of shadows the Fed's move, and we kind of see that in the pattern of rate hikes where Bank of Canada and the Fed are quite aligned over the past year in 2022. So with the rate hikes, the hikes in the prime rate in Canada pretty much match what we saw with U.S. Federal funds rate. So I think that's pretty significant. So I think that, in my opinion, I would see that as the most likely scenario. But with that being said, with that as the most likely scenario, when you look at previous rate hike cycles, and you look at the market movement into those cycles or during those cycles and preceding those cycles, um, you see a pattern. And again, I've been mentioning this where market is sort of forward looking, and I think that let's say we were to get a another rate hike, and it sort of closes off around end of the year. I think that now would be the time where uh, all of those hikes are really priced in, and and once you have the full breadth of rate hikes priced in, you end up at a final destination in the hiking cycle, and that is one of the market bottoms. So I think, in my opinion, we are looking at sort of bottom levels. I think we can go lower, which I mentioned. Although I think that the lower we go here is really just great buying opportunities, and that's in my opinion. These are kind of the buying territories. I think we can really dump, and I think possibly that could happen going into possibly if we get another rate hike, the next rate hike maybe in a month or 2 months, and that would cause a further plunge in the market, and then we sort of form a bottom overall. And if you look at the breadth of equities, and risk assets at these levels, you see the valuation uh, compression, and it sort of makes sense where when you're looking at valuations. I think if you look at, let's say, a Google, for example, you're looking at PE 17. You're looking at that's current PE, right? And you're looking at, for example, a Tesla. You're looking at 72 PE. I think that you could see possibly a further valuation compression, and I would see something that still makes sense, right? Something that actually makes sense of, let's say, a valuation compression of PE maybe 45, 50 on Tesla, for example, which would bring us down to maybe 150 levels on the stock price, which I think would form an absolute bottom. um, and Tesla in specific, we are heading into earnings this week, so we have quite a bit of earnings. I think earnings could act as a catalyst as well for possibly a a temporary bounce, because I think that overall, I think that if we were to see complete bottoming, I think that it would end up in going into the end of the year, so December end, and that would be because of the uncertainty in rates. and that would be determined by the Fed, which we would need to wait till early November, and then subsequently into mid December for if we see another one. And the market is going to price in another rate hike for sure because, as I mentioned when I posted the CPI, we are again still, CPI data is showing higher than expected inflation, and I mean we're at 8%, and the Fed is somehow targeting 2%, right? So I think that it's quite a ways off. A lot of it is to do with the war, though, and as I kind of predicted, my prediction is that the war will end quite soon as we head into the winter, and that is a result of Europe not being able to survive throughout the winter without their dependence on Russian nat gas, Russian oil, and again, I mentioned this a few weeks back, but this all comes down to economics at the end of the day, and Europe will need to get themselves out of this, and I think that comes in a form of dual negotiation between Russia and Ukraine, and I think that's the only option really. And really it's the only option because the other option is what Biden and US officials now, US administration, is kind of trying to lead towards, which is really just ends up in one way, which is nuclear war, which a lot of people are pushing against. So I don't think it would happen. And even if it were to happen, those are sort of the worst case scenarios where you can never price in. So you don't look at those with sort of any percentage chance when you're sort of pricing in prediction towards where the market goes. So um, yeah, that's my thoughts on my end. So I think that in my opinion, I think we see actually lower from here, but I think we'll get a temporary bounce because we are quite going into oversold territory, and with sentiment quite low, I think it pushes us into a bear market rally, kind of what we saw in June, but I think it would be less aggressive because June was quite aggressive when we hit the June low and bounced. We bounced quite a bit, so it was very significant. If you're playing short term, maybe on leverage or through options, utilizing derivatives from June to August, you would have made quite a bit of money. I don't think it'll be as aggressive. I think it will be a much smaller uh, bear market rally, but I think that it it kind of goes to strategy. So as I mentioned, in the beginning of the year when the Russian invasion began, I think you have to kind of shift strategies with the environment and climate of the market, and certain strategies are more efficient in certain markets, and in this market I think you have to sort of look at what the goal is. But I think that in the short term, um, some options plays might be good because we've had premiums drop quite a bit. I think throughout the year, the option premiums and with the volatility we've had haven't really been rewarding, and you can see that in some of the return on premium pricing that you see with quite possible large moves, and it's not really the risk reward isn't really there. But now I think it's not too bad, and I might open some positions where I will update everyone. Um, but I think overall still, I think that you'll see volatility kind of continue to decrease on a longer scale, and that means going into 2023, I think that you'll see quite flattish movement, so you won't see any really aggressive moves in the when you kind of expand the chart in a longer frame. Um, so yeah, but I think that with valuation compressions, some of these companies are looking extremely attractive, and when you're looking at a 3-year time horizon, you're looking at um, multiple X percentage, X times multiple return. So it's very attractive there. But yeah, that's my thoughts on my end. I'll add anything that I missed later on, but I'll just pass it on to DJ to share his thoughts and go over his usual SPY analysis. And we're also recording this, so we'll be uploading on YouTube, um, where anyone can watch some. DJ, pass it to you.
Yeah, sounds good. So, I echo most of Ranby's thoughts here overall. About a month or 2 months ago, I think about last month, I did foresee this kind of situation happening with the September CPI numbers, and I believe that would have been this drop right here on the daily chart, September 13th on that gap down and red. Um, I've We were coming off a very strong 2 month bounce from June to August. Um, in my opinion, if we got over 440 on SPY, that could have changed the trend back to bullish, but we bounced as high as 432. We rejected, we went back. And then I honestly thought it was kind of 50-50. If inflation came down a little bit and there were signs of pivoting coming, we could have potentially came back to retest the all-time high by year's end. But with the chart setup kind of around the 400 level, based on the weekly and monthly chart setup, it was very 50-50 in my opinion. Technically, it could have went either way, but because of the September CPI numbers and the language Powell used at Jackson Hole and what he said in September, I thought it was very likely that we were going to retest the lows on the S&P, if not lower. So I did kind of write out a warning piece, which I posted both in the group and on Twitter, where I said that um, I think that the Fed is clearly going to continue their rate hikes after this CPI data report, and I believe that is going to send the economy into a recession next year, but we won't see the effects until probably Q1, Q2. And um, I gave my rough estimate targets around 300 to 330 on SPY, and we I gave that target when we were around the 400 levels on September 13th morning. So we're basically 40, 50 points down from that level. We did break new lows. We broke new lows a bit quicker than I expected, to be honest. I thought we would, back test it and then hold the lows before kind of breaking later on in maybe sometime November. But we did flush quite hard from basically a 412 to 360 move, almost a 70 point, 60 point move, very fast down. And now we are technically not oversold on the daily because we did have a bit of a strong bounce recently, but we are definitely uh, in fear territory when it comes to sentiment. And we're at a spot where I do think overall there should be more downside. My my targets were 300 to 330 once again. I thought it could happen sometime around Q1 next year, but with how kind of accelerated things are getting right now, um, which I thought was possible, but again, not my base case. But I think with how things are accelerated, there is a realistic scenario we might see the flush and capitulation by year end to reach somewhere between those targets of 300. And if we get that scenario, and we could possibly form a longer term bottom from there, or at the very least we'll have a very significant rally off those levels if we do capitulate there. If we relief rally and chop for a few months, then I think ultimately I still think we do need to test that 300 level on the S&P roughly, but it will be prolonged. So it, it may be actually better just to try to capitulate into it instead in a longer term perspective than dragging it out. But it's kind of tricky because I feel like a lot of charts and sentiment it's fearful. Charts are oversold. Stocks have overshot to the downside. But at the same time, um, a lot of the kind of price targets overall, and in the sense, is that we need to go lower, but it's just the speed is a bit quick. So we're at kind of this point in time where it could kind of go either way, and there's a real case for it. I'm leaning towards the relief rally um, for about a week or two, or it doesn't need to be a week or two, but I'll say I think we're due for about a 5 to 8% um, relief rally in the indices, just to cool down some things, reset the daily, weekly a little bit before kind of retesting down. I do think a lot of bad catalysts and rate hikes have already been priced in my opinion. I'm not really surprised by the recent CPI or the need for rate hike in November, December. I do believe 75 in November and 50 in December is the base case, which markets have priced in. I think we're actually dropping because of earnings season coming, and I think people are pricing in the severe uh, guidance drops that is going to happen in the forecast for these companies. How high the U.S. dollar has been and rate hikes for next year. Um, a lot of companies have already come out and pre-leaked their earnings or given guidance or a lack of guidance have gotten, you know, plummeted very hard. Stuff like FedEx, for example, and AMD. I think it's kind of a no-brainer that pretty much every, large cap, medium cap, small cap reporting is going to be guiding down for the most part, unless you're in some specific sectors. But that basically means that um, we'll be in a situation where we see in the upcoming earnings, which is next week. Next week starting is Fang. Um, sorry, 2 weeks after actually. Next week would be stuff like Netflix and Tesla, and then the week after is large cap tech. And that really kicks off earnings season. I think a lot of their guidance have already been priced in to the markets, but the degree of it is still unclear. I do think that if we drop very significantly downside based on their poor guidance, that is probably a short-term capitulation event. And if we get a relief bounce, that's kind of all the same. Um, and it just kind of drags things out. Um, So I think that's pretty much the key here. But short term, I'm leaning kind of just bullish. Fear and greed is around 21 right now as of Friday close. I think anytime it's really under 20, 25 when you're looking at a probably a 2 to 4 week time span, probably 90% of the time, stock prices will be higher just because of how oversold we are on the sentiment level. I think Thursday is kind of a good hint. We gapped down very hard on the CPI into fresh new lows on indices and a lot of stocks, and then we had a 4 or 5% reversal on a short squeeze. So we are in this point of time where it's very easy, for bear market rallies to occur because once they kind of start going, it's kind of hard to stop given that we're just extremely oversold and we can rally significant amount of percentage and points and still be in a bear market trend. So that part is quite difficult to grasp. I think chart wise, it's clear we're kind of downtrending. I think we're reaching kind of near the end of this downtrend, just before a bounce, because this is about a 2 month downtrend and we're down about 20% on the S&P. And I think based on Thursday's buying, it does look like the bottom should be in. If not, I think we will see right on Monday next week if we are going to break into new lows. I do think if we can hold this low and hold, let's say, 350 by Monday, it would make a higher low or double bottom, and I think that might be enough just to create at least a few days worth, if not weeks worth, of kind of relief where we kind of grind back up to the 360, 370 levels again on the S&P. But I think overall the daily chart is not that important. Uh, at least if you're trying to make intraday trades or very short-term time frame. I think for the most part, the strategy, should be looking forward, the next year, the next 2 years, next 3 years. There will be significant opportunity. Even a lot of stocks right now, at their current prices and multiples, like a lot of them sure can go lower, but they're probably already multi-baggers in long-term perspective, even at current levels. So it's that's the outlook I think people should be having. Um, Short term, whatever day trade here and there, have an account there, but longer term or medium term swing accounts, long term kind of just holding accounts. I think you know this is definitely a point in time to be adding to the companies that you like, and it will definitely return well, even if it might not necessarily beat a bottom. And another thing is indices might not have bottomed, but always a chance individual stocks could have bottomed. Um, Obviously, they trade correlated most of the time, but there's some stocks already down 85, 90%, for example, that might have been overdone. And if they see a relief rally while the S&P just bounces, say a couple percent and they go up 20, 30%, then ultimately even the S&P or QQQ had another 10, 15% lower. Those stocks might not actually be as low as they are right now. So yeah, I think dollar cost averaging and just grabbing positions there is fine. I want to cover S&P SPY weekly chart. The trend is quite clear in the weekly chart. Ever since we broke down here, we did have an official kind of bear break confirmation for the first time in 2 years. And then ever since we have been bearish, we had that two month rally up. But like I said, we could have rallied to as high as 440 levels, which would still keep us below the weekly upper Bollinger Band. And we did reject that level, and then we came back down. So each kind of move has been a, a lower high into a lower low into lower high into lower low, and we are kind of continuing this trend. Weekly, we are still a little bit from oversold levels, but I do think this could very well be the bottom. We're somewhere around 340 levels for a short-term relief rally. I think we are starting to slope down pretty quick with the weekly EMA, so we probably need to, regain, a couple weeks of green shoot us back to at least, somewhere between 360, 380 levels, just to kind of cool down things before another move down. Monthly chart on SPY is what I think is kind of the most glaring and kind of why I think the 300 kind of target range seems a little bit inevitable to me with just kind of the monthly chart setup. There's kind of some key areas, and this would be 320, where there has been previous support in August 2020, and then we would go down to the 280 support in June, and a good midpoint would be around the 300 level in between. And we are starting to slope downwards. We got a negative cross between EMA, so if we do not bounce back soon, it does looks like in about a month or two we could potentially have that capitulation move down. Or if we chop back, then we could either form a bottom already here, or possibly chop back into Q1 Q2 of next year before dropping further. QQQ daily, same thing as SPY really, not not too much different. Monthly chart setup, a bit more bearish, but we are starting to see kind of a bearish trend on the monthlies, where we're breaking down below the lower monthly Bollinger Band. We're still about 20%, 25% above the COVID levels on QQQ, similarly on SPY. So I think if we just retrace and retest those levels, would be a reasonable kind of level to settle at, in my opinion. And then last thing I kind of just want to mention roughly is this kind of uh, chart right here. It's basically like a kind of a investor sentiment slash market psychology type of thing, where it's just typically how people think and feel kind of dictate kind of market points in time pretty well. And I think there is obviously a bit of hindsight and stuff on this chart, but definitely when we peaked in November 2021, the entire market was definitely at euphoria, thrill and euphoria, where everybody thought we would keep going. There's a huge camp in the melt up camp, etc., and there didn't seem like inflation would become a big deal, blah blah blah, and then we're starting to down. We have anxiety, denial, fear, desperation, panic, capitulation, despondency. I think we it's hard to say where we are exactly here, in my opinion, but personally I do not even think we have reached the panic stage. I would say at most we're somewhere in between desperation and panic, but in my opinion right now we would be somewhere between fear and desperation, actually. um, so my reasoning is, uh, I think for many many months and throughout the whole year there was always this narrative and kind of shift where people thought the Fed would pivot, and the Fed would not hike as much, or slow down the rate hikes, or pause the rate hikes, and then et cetera, et cetera. And I feel like it's only until very very recently, in the last month or two, and with the recent CPIs, that I feel like the market has finally kind of gave up that immediate Fed pivot kind of story, and are setting in is like, okay, we're accepting reality that rates are going to 4%, and that we're going to be in restrictive territory for the foreseeable future. So I think just getting past that gets us past the denial stage. And I do definitely see a lot of fear out there. So I do think we're probably a bit past the fear stage, but I don't really see much desperation or panic on my end. Definitely not capitulation. I don't really see any mass fear where it's you know just normal people who are working coming onto the markets and then just selling everything out of panic. That level hasn't come yet. There is some fear, but yeah, even panic. There's definitely no panic here. The VIX is 32. We haven't had any circuit breakers. We haven't had anything breaking the system yet. We hadn't had mass liquidation. Um, you know, Panic and capitulation would be similar to like a 2020 COVID situation, where really we were dropping very fast. 5%, 8% a day. there were circuit breakers, and everyone in the entire world was kind of waking up and just panicking, their monies and savings disappearing. I'm not saying we need circuit breakers to hit capitulation, or we need super large percentage drops, but it's kind of very clear to me that for the most part, people are going about their day-to-day lives right now, and there is no sense like I need to log in and sell out my stocks or anything like that. I think for the most part, there's a lot of people on the sidelines right now with a lot of cash, and they're kind of just waiting to kind of add and buy the dip. So there really is quite a lack of panic. So I do think there is further downside in the cycle. Um, the tricky thing is, it takes a long time to get through like the first few stages. It could take like half a year just to get through the first two, three stages. But the last kind of three stages from desperation, panic, capitulation, etc. That type of thing can happen really fast in the span of 1 week, in the span of 2 weeks. Something just breaks and then people start mass liquidating, and it's a really really speedy thing that happens usually when people don't really expect it to happen. So in my opinion, we're probably not going to see that this month, and I don't really see that coming in Q3 earnings. It's usually a type of event that happens that catches people off guard. And I think it's kind of just too obvious. Everybody knows that the guidance and forecasts are going to be bad. So I think you can't panic and capitulate in this type of event. So I think it's very likely we will see a relief rally short term. And I'm not sure what it will be, but until we capitulate, we're going to need a catalyst. It could be, you know, a wide range of things with the how the war is going and the semis and the potential Taiwan stuff, but that's kind of like all speculation. So until we get there, it doesn't really matter in my opinion. For the most part, I think short term relief rally, longer term we have more downside to come, but also do think um, averaging in and holding long term at current prices, um, as long as you're having a healthy amount of capital and cash to add further on the downside, I think is a good move. So that's my thoughts for now. Ramsey, if you want to add anything.
Yeah, no, I shared my thoughts there, so I urge anyone to watch when we upload on YouTube and listen to that. I think I should be pretty accurate on my forecast uh, heading into the end of the year. I actually think that the 300 to 320 um, target uh, could be pretty accurate. I would agree with that. I would be quite aligned, um, given where we're currently at to where I think that we would need sort of a further plunge to get us to a good bottom level to kind of settle at. Um, but in regards to the chart, I think, in my opinion, I would disagree, and I would say that on my end, I would put us at the panic level, in my opinion, and I think capitulation and the final stage would be us heading to sort of that 300, 320 level, possibly, and sort of settling there. Um, so that's where I would put us, in my opinion, on my end. But I think those targets are pretty accurate on my end. So I'd agree over there. But yeah, those are my thoughts on my end. So we will be uploading this to YouTube shortly, either later today or tomorrow, which would be October 16th. So yeah, look out for that. I hope everyone has a amazing remainder of the weekend, and we'll be back on Monday to go get this money, guys. So take care, everyone, and have a great remainder of the weekend.
Yeah, take care, everyone. Cheers.